And while we've seen Asian markets really climb higher this morning, the mood in India, while in the green, is still a little more somber as compared to its Asian peers. In fact, Indian benchmark indices, Sensex and Nifty are up less than about half a percentage point each in early trade. Remember, this is data in just the first 5 minutes of trading. Sensex well below that psychological 80,000 level, and Nifty 50 also below the 24,600 mark. Meanwhile, the small cap and the mid cap space performing better than the broad markets, but volatility in the Indian markets is extremely high. In fact, it's more than 19, when remember the average level of about 12 is what the Indian investors have become accustomed to. So massive swings in the red and the green have pushed up India VIX by about 9% or so. Let's move on now to the Nifty 50 heat map and try and see which are the sectors which are adding to the gain this morning. And of course, we will come to the energy stocks in just a bit. But beyond that, there is some recovery in the IT pack as well. In fact, TCS had opened stronger before falling into the red again this morning. TCS, HCL Tech, both in the red in the first 5 minutes of trading, while Infosys holding and taking cues from the US markets, especially the tech sector stocks, up by about almost flat. In fact, now Wipro up about a third of a percentage point each. Meanwhile, Reliance Industry is up almost 2% or so. The energy stocks are definitely having a good day, a good bull run in the markets today. This coming after news of the US helping to resume operations in the Strait of Hormuz. So pretty much the entire energy pack led by Reliance Industries, but even ONGC, Coal India, BPCL, HPCL and IOCL both, in fact, all these stocks in the green this morning. Some recovery, and what we are seeing potentially on the broader markets is a reflection of the energy market performing well. Let's put this into perspective with Rohit Srivastava, founder and market strategist, Indiacharts.com, who joins us this morning. Rohit, good morning. At least some green shoots in the markets, and this coming after we saw 5 days of absolute bloodbath on the markets worldwide, including in India. But energy pretty much seeming to lead the way this morning. Where does the story pan out for the rest of the trading day today and for the next few days?
So it's interesting because, the last couple of times when I was sounding slightly negative, it was more based on the economic, data points.
Yeah.
And what we've ended up is with a situation which is war. And I'll just highlight to you, you were talking about the India VIX some time back. And we do try to judge where the market is based on the VIX.
Okay.
And we've had at least had 4 to 5 occasions in the last, 1.5 year where we've crossed the 20 level. And we've recovered from each of those. So the first one was in August of 24, which was the yen carry trade Adani fiasco coming back into light.
That's right.
And that didn't last very long. And then we had the tariffs in April of 2025 last year.
Right.
And that also we saw us recover from there. The VIX had actually gone to around 22, 23. And then there was the India-Pakistan war, when also the India VIX reached 22. So yesterday we've actually gone to almost 21.3.
Yeah.
Which is getting us very, very close to the territory from where markets have often recovered. Now, the catch here is that, yes, the bet has to be that we've priced in the worst of the war and it's not going to get worse than what it already is. And if that is true, then there's probably not more downside, at least on this particular news flow. And that is where there may be some short-term recovery in markets in the near term. So we should not be now we shouldn't be too bearish on the situation till we can really confirm that things are going out of control. Otherwise, we might have discounted it and things might only normalize from here. What we'll have to then judge is, whether this becomes a prolonged phase.
Yeah.
One, and two, whether we again go back to start looking at economic data and trying to discount that. So those are going to be two separate things. But in the near term, the oversold condition should give us some bounce back in the Nifty from, the lows of almost 24,000. 400 that we touched. Maybe retesting 25,000 to start with is what I'm thinking about. So that's still 400-500 points higher than where we are right now. That should be an initial move. I think 25,000 is where we gapped down from when the news broke out over the weekend. And that is the level that we would want to really get past to overcome the negativity altogether.
Absolutely. So that's still about 400 points or so to go. Meanwhile, you talked about the potential of this being a prolonged war, and in fact, a lot of anticipation around the length of the conflict in West Asia. Now, let's presume for a moment that it does end up becoming a prolonged war, and in that scenario, is there going to be an impact on India's fundamentals? And there are key questions that investors are grappling with. First up, can India's oil reserves hold up during the supply disruptions, especially in the Strait of Hormuz, even though we are hearing from the US that it may try to secure the Strait of Hormuz and aid the supply of fuel tankers. Then, of course, we've also seen, Rohit, the LNG disruption, especially coming from Qatar, and that is likely to mar domestic production. Add to that, of course, if oil prices continue to be high, the rupee continues to depreciate, will India import war-linked inflation? And that is something which could, again, cast a shadow on India's own growth projections. And then, of course, expectations, rupee depreciating. Should the Reserve Bank of India intervene already or wait it out and see how long this war is likely to be? And finally, of course, there are also fears, Rohit, on exports, especially the MSME exports to Europe and US, as shipping routes continue to be disrupted and insurance continues to be a lingering issue for ships. So overall, given all that we are seeing in West Asia, if this happens to be a prolonged war, then is India's own domestic fundamental story also at the risk of being threatened?
So it's not just India, right? If you have a prolonged war and if it escalates, if tried to touch parts of Middle East, then it ends up affecting, many other parts of the world as well. Europe is a major oil and gas importer for their energy needs and, cooling during winter periods and many other reasons that we can think of why the world economy itself would slow down if this escalates further. Now, there are two parts to it. One is escalation and one is, as we said, a prolonged war, which is that it takes time.
Right.
Now, if you can contain it within the region and it is prolonged, just like what happened between Russia and Ukraine, it's still ongoing. The rest of the world moved on. So, which situation are we going to face? Are we going to face a situation where the world just moves on? Are you going to face a situation where the whole world gets involved in this? The second one is, of course, worse than the first. The first one you can sort of discount because it's like if you have something which is temporary, even though there may be a near-term impact on growth, if you can say that 3 months down the line, all that will normalize, then markets would stop falling at that point of time because you would not, sell everything just because something is, going to be taking time, but eventually going to get resolved. So you'll have to discount it based on what really happens, whether you can say that the economic slowdown is temporary or it's going to be, more time consuming.
All right, fair enough. But what should investors really do at this point? And I'm specifically talking about retail investors, because over the last 5 days, today being an exception, but over the last 5 days, Nifty 50 had plunged about 4.5% or so. Sensex was down by more than 3,500 points in the last 5 days. Overall, we saw that the IT stocks, despite the turmoil, had performed better than the benchmark. So what should be the strategy for retail investors right now? Buy the dips, buy the bottom, or just continue with your SIPs, continue by accumulating quality stocks and wait it out and wait for the levels that you spoke about, the immediate sort of resistance at about 25,000 points for the Nifty and maybe above 80,000 for the Sensex. Should they just wait it out, or should they continue aggressively buying quality stocks when prices are low?
So, between Jan and Feb, one of the strategies that I was putting out was, to either create some level of cash and so that you can buy it when the next opportunity shows up. And the second one is if you are not able to sell your portfolio, because a lot of long-term investors prefer to just hold on, or as you're saying, continue to invest, then probably look at buying hedges. Not everybody is comfortable again here because buying hedges means you buy some kind of puts, and we were recommending the December 2026 puts actively to our clients. Now, what do you do in the current situation? Because the market's already fallen. What I would say is wait for it to bounce back because you're getting some sense of normalcy that, okay, this is not going to escalate but may take time. So that is the first sense, which is why you're seeing a lot of recovery in both US and Asian markets on the idea that, okay, maybe things will stabilize. Now, if we get that kind of a bounce back, I mentioned maybe back to 25,000, or if you're lucky, a little above that, then that would probably be another opportune time to, build those hedges and leave them there. Because I don't think any of us are smart enough to predict how this war moves on a
Right.
day-to-day basis? Do you get other geopolitical angles to it, involvement from other countries? We don't know that at this point of time. The ideal way would be that when it bounces back and maybe the VIX cools down a little bit, you are able to buy those hedges again. That would make it easier for you to sleep over a investment portfolio than to liquidate in panic. So I think look at this bounce as an opportunity to de-risk or create hedges so that you don't worry about it too much. And that will then allow, and then wait for an opportunity to invest for sure. I think we would want to see much more clarity on the war front before we start investing, new money. Now, if you have existing SIPs, as you're saying, the purpose of SIPs is designed to buy dips and buy the decline. So it's hard to persuade people to, end those. Though I know a lot of people do end up panicking and cutting off their SIPs. But I think a better strategy is really to create cash and hedge, and keep and wait for an opportune moment.
All right. I am also looking at IT stocks again. They have slipped into the red this morning. We saw they opened much stronger and taking cues, of course, from the US big tech stocks, which were up in trade yesterday. But again, we are seeing massive profit booking in the IT stocks. Has this got anything to do with war, with the US dollar, with the US economy, or are we still seeing the AI fears play out on India's IT stocks?
So again, India's IT sector may look slightly oversold on short-term indicators, so there is a case for a bounce. But if I take a slightly longer-term view, that would not change. That they are going through a period of extremely slow earnings growth. The valuations were high because they were being treated as a defensive sector. What the AI trade has really done is it's taking off that valuation premium that the sector was getting. And once that valuation premium is significantly cut, you can't be at 20 times earnings for earnings growing at 5 to 6%. So once you cut that in half, then at that point of time, the sector may show attractiveness again. Now, even if you look at global software stocks, they've not really moved up a lot yesterday. There's some bounce back, but it's limited. So I guess you can get a near-term bounce, but it's not yet an investment. It's not yet time to be investing in IT stocks with a long-term perspective.
All right, don't invest in IT stocks from a long-term perspective just as yet. Before I let you go, Rohit, I also want to pick your brains on something which came from the US yesterday, where we heard, Treasury Secretary Scott Bessent saying that, and this was to an interview to CNBC, that tariffs of 15% are going to be back on the table within a week or so. Now, remember, last when we were speaking about tariffs, we had come down to 10% after the US Supreme Court had struck down US President Donald Trump's tariff regime. But now that 10% likely to go up to 15%. Is that something that, markets have and market players have already priced in?
I would think so. I mean, moment they made that announcement, within 2 days, we were aware that they're going to go back to 15, and it's also possible that they can inch up towards the original 18, which was there through maybe other measures. So we should expect the deal to remain the same. I think Donald Trump himself has also reiterated that he wants everyone to stick to the trade deals that he's done with them, and so I don't think anything really changes on that front, and it's definitely discounted with when the deals were announced at the start of February.
Let's leave it at that for this morning. As always, pleasure having you here with us on Newsline, and thank you so much for your time.